While you were sleeping, a document was quietly released. No headlines, no breaking news alerts, no Wall Street panic. Just one line buried deep inside a government file that is about to change the price of every single, sitting anywhere in the world, ounce of silver. Right now, Russia didn't just buy silver, they declared it a weapon. And the most terrifying part, the rest of the world hasn't noticed. Yet, welcome to Currency, with your host, John. Now, before we go any further, if this is your first time here, look at that subscribe button. Go on, look at it. It won't bite. Think of it like locking your front door at night. You've done it for decades without thinking twice. One small click, and you never miss what's coming next. That's all it takes. And to those who have been here from the beginning, you already know, every single video on this channel exists for one reason only, to make sure you see what's coming before the crowd does. Now, where are you watching from today? Drop your city, your country, right down there in the comments. It doesn't matter if you're in London, Lagos, Lahore, or Los Angeles. This story belongs to every single one of you. Because what Russia just did affects every currency, every market, and every business decision you will make in the next 3 years. Now, let's get into it. On a quiet Tuesday morning in March of this year, Russia's central bank released a budget document. It did not arrive with sirens. There was no press conference. No senior official stood before cameras to explain what had just been written inside that file. The Financial Times did not run it on the front page. Bloomberg published nothing. CNBC was occupied elsewhere entirely. And yet, buried inside that document, between rows of budget figures and government allocations, sat a single line that financial analysts, geopolitical strategists, and serious investors should have circled Russia had formally designated silver as a strategic reserve asset. Immediately. Not informally. Not as a passing footnote. Formally. Written into the federal budget for 2025, 2026, and 2027, the allocation stood at 51.5 billion rubles per year. That translates to approximately 535 million US dollars annually, locked in, committed, and directed specifically towards the acquisition of precious metals, and silver was named explicitly alongside gold, platinum, and palladium. To the untrained eye, this reads like a routine government budget line. Numbers move through government documents every day. Most mean nothing beyond the fiscal year they represent. But this one is different. And understanding why it is different requires understanding one fundamental truth about central banks and silver that mainstream financial media has quietly forgotten over the past 4 decades. Central banks do not buy silver. Not like this. Not formally. Not at sovereign scale. Gold has been the reserve metal of choice since the collapse of the Bretton Woods system in 1971. Nations accumulate gold as a hedge against currency debasement, geopolitical instability, and dollar dependency. That logic is well understood and widely documented. Between 2022 and 2024, central banks globally added more than 1,000 tons of gold annually, the highest sustained accumulation rate in modern recorded history. Silver, however, was left behind. It was categorized as too industrial, too volatile, and structurally too difficult to store at the scale required by sovereign institutions. Central banks quietly removed silver from their reserve conversations. And for decades, that exclusion held, until now. When Russia placed silver on the same official document as gold, it did not do so by accident. Sovereign budget documents at this level go through multiple layers of review, approval, and political sign-off. Every word carries intent. Every allocation carries strategy. So the question that serious analysts must now ask is not whether Russia is buying silver. The document confirms that it is. The question is far more consequential than that. Why silver? Why now? And why has almost no one in the financial press bothered to ask? The answer to those 3 questions does not begin in a trading room or on a commodity exchange. It begins in February of 2022, the moment that permanently altered how every sanctions-exposed sovereign nation on Earth thinks about the money it holds, where it holds it, and how quickly it can disappear. There's a date that every central banker, every finance minister, and every sovereign treasury official on Earth now knows by heart. February 26th, 2022. It was not a market crash. There was no bank run. No currency collapsed that morning. No single company filed for bankruptcy. What happened on that date was something far quieter and far more permanent. With a series of coordinated announcements from Washington, Brussels, London, and Tokyo, approximately $300 billion in Russian foreign exchange reserves were frozen. Not seized, not destroyed. Simply immobilized. Locked inside the very financial infrastructure that Russia had spent decades building its economy around. $300 billion. Gone. Not in value. Not in existence. But in function. Completely and utterly useless. Overnight. For Russia, it was a financial earthquake. But for every other nation on Earth that held reserves inside Western-controlled financial systems, it was something else entirely. It was a warning, and warnings of that magnitude do not go unlearned. Within months of that freeze, a quiet but fundamental shift began moving through sovereign treasury departments from Beijing to Riyadh, from Tehran to New Delhi. The question being asked behind closed doors was no longer, how do we grow our reserves? It was something far more urgent. How do we hold wealth that cannot be frozen, sanctioned, or made inaccessible by a foreign government? Gold answered part of that question. Physical gold held domestically cannot be frozen by a foreign power. It cannot be immobilized through a swift exclusion or a treasury directive issued in Washington. It exists in the physical world, tangible, countable, movable. This is precisely why central bank gold buying accelerated so dramatically after 2022. The connection is direct, the logic is undeniable, but gold alone was not enough. And this is where Russia's thinking moved into territory that almost no financial analyst has yet mapped publicly. Silver is not simply a precious metal. That framing is decades out of date and dangerously incomplete for anyone trying to understand what is happening right now. Silver is the most electrically conductive element on the periodic table. It is irreplaceable in the manufacturing of solar panels, electric vehicle components, advanced semiconductors, military-grade electronics, and next-generation weapon systems. There is no synthetic substitute. There is no cheaper alternative that performs at the same level. When a defense industry, an energy sector, or a technology supply chain requires silver, it requires silver. Full stop. Russia understands this better than most. Its economy is built around resource leverage. It has used energy, natural gas, crude oil, as both an economic engine and a geopolitical instrument for decades. The logic of extending that same resource leverage doctrine into critical industrial metals is not a leap. It is a natural and calculated progression. By formally designating silver as a strategic reserve asset, Russia is not making an investment decision in the way a hedge fund manager might. It is making a doctrine decision. It is positioning silver the same way it once positioned gas pipelines, as something the world will eventually need. And Russia will quietly control more of than anyone realized. Now consider the supply side of this equation, because the demand story alone does not explain the full scale of what is developing. Above-ground silver reserves, the silver that is already refined, stored, and available for immediate use, have been declining steadily for years. Unlike gold, which is primarily stored after it is mined, the vast majority of silver mined throughout history has been consumed, used in manufacturing, dissolved into electronics, dispersed into products from which it cannot economically be recovered. The Silver Institute's own data shows that global silver demand has outpaced mining supply for 3 consecutive years. The deficit is not theoretical. It is structural, it is measurable, and it is widening. Into that widening deficit, a sovereign central bank just walked through the door. Not a retail investor, not a hedge fund, not an ETF manager watching quarterly targets, a government with a multi-year budget commitment, with 300 billion reasons to never again store its wealth inside someone else's financial system. There's a particular kind of danger in financial markets that does not announce itself. It does not arrive with a crash. It does not trigger a headline. It does not show up in a quarterly earnings report or a Federal Reserve press briefing. It builds slowly, quietly, and structurally, underneath the surface of everything that analysts are watching, until the moment it cannot be ignored anymore. By that point, it is already too late to position ahead of it. What is building right now in the silver market is precisely that kind of danger. And the reason almost nobody is talking about it comes down to one fundamental miscalculation that institutional finance keeps making repeatedly about silver. They keep pricing it like a commodity. It is not just a commodity anymore. To understand the scale of what is developing, one must first understand how central bank buying behaves differently from every other category of market participant. When a retail investor buys silver, through a coin dealer, an ETF, or an online brokerage, the transaction is reversible. The moment sentiment shifts, the moment a better opportunity appears, the moment fear turns to complacency, that investor sells, the silver returns to the market, price pressure dissipates, the market absorbs it, and moves on. When an institution buys silver, a hedge fund, a commodity trading desk, a large family office, the holding period is longer, the position is larger, but even here the logic is performance-driven. Quarterly targets, investor mandates, risk committees. Eventually, the position is unwound, the silver comes back. When a sovereign central bank buys silver and places it inside a formal strategic reserve framework, it does not come back, ever. Sovereign reserve assets are not traded for profit. They are not unwound during market corrections. They are held as permanent structural ballast, the same way Russia holds its gold, the same way the United States holds its military petroleum reserve. Once it enters the sovereign vault, it exits the available supply permanently. The market loses that silver, not temporarily, permanently. This distinction is not academic. It is the most important variable in the entire silver pricing equation right now, and it is the variable that Wall Street is not yet modeling. Now layer on top of that the industrial demand picture. Because sovereign accumulation is only one side of a supply compression that is building from multiple directions simultaneously. The global transition toward renewable energy infrastructure is not slowing down. It is accelerating. A single solar panel requires approximately 20 grams of silver. The International Energy Agency projects that solar capacity installation must triple by 2030 to meet stated climate targets. Triple? That number alone represents a silver demand figure that current mining output cannot satisfy, even before accounting for electric vehicle production, advanced semiconductor fabrication, and next-generation defense electronics. The defense dimension deserves specific attention because it is the least discussed and most consequential component of near-term silver demand. Modern precision-guided munitions, radar systems, drone electronics, and hypersonic missile components all require silver in quantities that have no substitute. As defense budgets across NATO, Asia, and the Middle East expand in response to a deteriorating global security environment, and they are expanding measurably and rapidly, industrial silver consumption from the defense sector alone is projected to increase by double digits annually through the remainder of this decade. Russia knows this. It is not a coincidence that a nation actively engaged in the largest land war in Europe since 1945 is simultaneously moving to secure silver reserves at the sovereign level. The connection between military-industrial demand and strategic silver accumulation is not a theory. It is a doctrine being written in real time. Consider now the gold-to-silver ratio, one of the oldest and most reliable structural indicators in monetary history. At the time of this analysis, it takes approximately 80 to 85 ounces of silver to purchase 1 ounce of gold. Historically, that ratio has averaged between 15 and 30 over centuries of monetary usage. The current ratio is not a reflection of silver's diminished importance. It is a reflection of silver's systematic exclusion from the reserve conversation, an exclusion that Russia just formally ended. Every time in modern history that the gold-to-silver ratio has stretched this far above its historical mean, a reversion has followed. In 1980, silver moved from $3 to nearly $50 per ounce inside 18 months. In 2011, it ran from $18 to $49 in under a year. Both of those moves were driven by investor demand alone, without a single central bank formally entering the market as a sovereign buyer. What happens when sovereign demand enters a market already running a structural supply deficit? History does not have a clean answer for that question, because it has not happened before. Not like this, not with this combination of industrial compression, geopolitical realignment, and formal reserve doctrine shifting simultaneously. The market is not pricing in sovereign accumulation. It is not pricing in the defense demand surge. It is not pricing in 3 consecutive years of supply deficits. It is not pricing in the gold-to-silver ratio reversion that monetary history says is coming. It is pricing silver like it is still 2015, like it is still an industrial byproduct that moves with copper and trades in the shadow of gold. That mispricing is the opportunity. But opportunities of this scale do not wait indefinitely. They open quietly, they close loudly, and the distance between those two moments is almost always shorter than anyone expects. Everything covered in this analysis up to this point has been observation. The document Russia released, the $300 billion frozen overnight, the structural supply deficit widening year after year, the gold-to-silver ratio stretched to levels that have historically preceded significant repricing events, the sovereign vault door opening for the first time in modern history, with silver on the other side of it. That was the briefing. This is the response. And before a single strategic recommendation is made, one thing must be stated clearly, because clarity at this stage matters more than anything else. This is not investment advice. This is a geopolitical portfolio signal. There is a fundamental difference between the two. Investment advice tells you what to buy to make money. A geopolitical portfolio signal tells you what the most powerful institutions on earth are doing with their own money, and asks you a simple, serious question. Are you positioned on the same side of that decision, or the wrong side of it? For the business community, for aspiring entrepreneurs, for young professionals building wealth in an era of accelerating geopolitical fragmentation, the framework that follows is built on 3 tiers, not 3 random options. 3 deliberately sequenced layers of exposure, each serving a different function in a serious long-term strategy. The first tier is physical silver. This is the foundation, not because it is the most exciting option, because it is the most structurally sound one. Physical silver, coins, bars, certified bullion held in personal possession or in allocated storage, is the only form of silver exposure that replicates exactly what Russia is doing at the sovereign level. It is tangible. It is not someone else's liability. It cannot be frozen by a foreign government. It cannot be zeroed out by a brokerage failure or counterparty default. The lesson of February 26, 2022 applies here directly. Russia learned that wealth stored inside someone else's system can be made inaccessible overnight. The individual investor who holds physical silver has learned the same lesson at a personal scale, without needing a geopolitical crisis to teach it to them. Position sizing for this tier should reflect its purpose. Physical silver is not a trading position, it is a reserve position. Between 5 and 15% of a liquid portfolio allocated to physical silver is not speculation. It is structural insurance against a repricing event that the market is not yet pricing in. The second tier is silver-backed financial instruments. For those operating within business structures, investment accounts, or portfolios where physical storage is not practical at scale, silver-backed ETFs, allocated silver accounts through regulated custodians, and silver futures contracts held through established exchanges provide exposure to silver's price movement without the logistical requirements of physical storage. The critical distinction here is the word allocated. An allocated silver account means specific physical silver bars are assigned to a specific account holder. They are not pooled, they are not lent out, they are not rehypothecated into someone else's position. In an unallocated account, the institution owes the holder silver. In an allocated account, the holder owns silver that the institution is merely storing. In a normal market environment, this distinction is technical. In a repricing event, when sovereign demand compresses available supply and paper, silver claims begin to exceed physical silver availability, this distinction becomes the difference between a profitable position and an unrecoverable one. Choose allocated, always. The third tier is silver-adjacent equities. Primary silver mining companies, silver royalty and streaming businesses, and diversified precious metals, producers with significant silver exposure, represent the leveraged layer of this framework. When silver's spot price moves, well-positioned mining equities historically move at a multiple of that price movement. A 30% increase in silver's spot price has, in previous cycles, translated to 60, 80, even 100% gains in leading silver producers. This leverage cuts in both directions. Mining equities carry operational risk, jurisdictional risk, and management risk that physical silver does not. They belong in the third tier, not the first, precisely because they are the highest reward and highest risk component of this framework. For entrepreneurs and business-minded individuals comfortable with equity analysis, this tier offers the most asymmetric upside in the event of a significant repricing. For those less comfortable with individual equity selection, silver-focused ETFs that hold baskets of mining companies provide similar directional exposure with reduced single-stock risk. Now consider the timing variable, because timing in a situation like this is not about finding the perfect entry point. It is about understanding how these repricing events unfold historically, and where this one currently sits in that sequence. Sovereign accumulation is stage 1. It is quiet. It is underpublicized. It happens before institutional analysts begin adjusting their models, before mainstream financial media runs the story, before retail investors flood into the asset class and compress the available opportunity. Russia's budget document represents stage 1. It has already begun. Stage 2 is institutional recognition. This is when large asset managers, commodity-focused hedge funds, and sovereign wealth funds outside of Russia begin incorporating sovereign silver accumulation into their own positioning models. Price begins to move with more consistency. Volatility increases. The gold-to-silver ratio begins its historical reversion. Stage 3 is public awareness. This is when the mainstream financial press runs the story at scale. When silver appears on the front page of Bloomberg. When CNBC dedicates segments to it. When the retail investor, always the last to arrive, enters the market in volume. By stage 3, the majority of the price movement has already happened. The audience watching this analysis right now is sitting at the transition between stage 1 and stage 2. That gap, that specific window between sovereign accumulation and institutional recognition, is historically the most valuable position an informed investor can occupy. It is where the asymmetry is highest, where the risk-reward ratio is most favorable, where the cost of entry is still rational and the potential upside is still largely uncaptured. That window does not stay open. It never does. The document Russia released was public. It required no leaked intelligence, no insider access, no privileged information to find. It was sitting in an official government budget file, available to anyone with the analytical discipline to look past the headlines and read what was actually written. The signal was clear. The structural case was already in place before Russia formalized it. 3 years of supply deficits, accelerating industrial demand, a gold-to-silver ratio at historic extremes, and a geopolitical environment that is dismantling the reserve frameworks that made silver irrelevant to central banks for decades. Russia read that signal and acted on it at the sovereign level. The question this analysis leaves every viewer, every entrepreneur, every business-minded individual with is a simple one. Will you read it and act on it at yours? The document was public. The signal was clear. The only variable now is who acts on it.